Hey everyone, welcome back. Today, we are diving into what is happening right now with silver, why prices exploded higher, and what could happen next for investors in the United States. This update is built on real market events, data, and recent industry reports, so you can make better informed decisions. The simple headline is this: silver has climbed to multi-year highs in September 2025, driven by a combination of central bank action, investor flows, and tightening physical supply. Those moves pushed silver into price levels not seen since the early 2010s and created major attention from both retail and institutional buyers. Why this matters to a US audience? Silver matters because it plays two roles at once. It is both a monetary metal that reacts to macro news and a critical industrial metal used in solar panels, electronics, medical devices, and more. That dual identity means silver can move faster and farther than gold when macro shocks combine with real economy demand shifts. Investors in the United States need to watch both central bank policy and industrial consumption trends to understand the likely path for price and risk. The immediate catalyst: the Federal Reserve decision. Earlier this month, the Federal Open Market Committee moved to cut its policy interest rate. The decision tilted expectations toward easier U.S. monetary policy and pushed real interest rates lower. That reduces the opportunity cost of holding non-interest-bearing metals and weakens the U.S. dollar, which makes dollar-denominated commodities like silver more attractive for global buyers. The timing of that Fed pivot is a major reason silver accelerated higher in September. How investors responded. The reaction was fast and visible. Precious metal exchange-traded products and funds saw substantial inflows as investors repositioned into physical-backed silver vehicles. Those inflows draw on vault inventories and remove metal from available supply, which itself creates upward pressure on spot prices. Trading desks also reported heavier speculative positioning on futures markets, which amplified the move. The supply and demand backdrop that matters most. To understand whether the rally can sustain, we need to separate transient drivers from structural ones. Supply side. Global mine supply and above-ground recycled metal have been under pressure. Relative to historical demand growth, mining production has not kept pace, and recycling has limits when prices and economic incentives do not favor rapid supply expansion. Reports published this year show global silver supply remains relatively constrained, which means that even moderate increases in investment demand can create outsized price moves. Industrial demand, especially photovoltaics. Probably the single biggest structural wildcard is silver demand for photovoltaic cells. The solar industry consumes silver for cell contacts, and although technology reduces per-panel silver loading, overall demand from a huge global build-out can still grow materially. Recent forecasts indicate that photovoltaic demand could rise sharply by the end of the decade and could require more physical silver than current production profile supply. That creates a structural bid under prices that is independent of monetary policy. Practical explanation of how these forces interact. When the Federal Reserve signals easier policy and the dollar softens, investment demand increases and ETF inflows pick up. At the same time, industrial users continue to buy for near-term needs. If mine production and recycling cannot respond quickly, that metal is taken off-market and prices rise faster than they might in a more elastic market. The net result is a classic supply-demand squeeze that can push silver higher in a compressed time window. Where price stands today and technical context. This month, silver traded in the low 40s per troy ounce region and at times pushed into the mid-40s, marking the highest level since 2011. Technical traders point to momentum indicators as showing strong bullish conviction, but also warn of overbought conditions, which can prompt sharp pullbacks during profit-taking or if a key macro data point surprises on the upside for the dollar. Recent reporting captured the multi-year high and stronger relative performance versus gold. Scenarios to watch and what would make each happen. Bull case. The bull case requires continued Fed easing, or at least the market pricing of multiple cuts a year or two out. A sustained weaker US dollar further supports commodity demand. In parallel, persistent strong industrial offtake, especially from solar projects and limited ETF liquidation, will keep available supply tight. Under that combination, silver could extend gains and test structural resistance highs from past cycles. Key signals to watch include further Fed guidance, U.S. inflation readings, and large announced purchases by ETFs or major industrial buyers. Base case. In the base case, silver remains volatile and trades in a higher range compared to last year, but without a runaway move. Prices consolidate around the current elevated zone as speculative long positions and some profit-taking balance industrial demand. The Fed may pause after initial cuts if inflation is stubborn and the US dollar may stabilize. This scenario keeps silver attractive as a hedge, but reduces the odds of immediate new record highs. Bear case. The bear case occurs if inflation re-accelerates unexpectedly, prompting the Fed to reverse course and raise rates again. A stronger dollar and higher real yields would hit non-yield-bearing metals hard. At the same time, if ETF holders decide to take profits at high price points and vault inventories begin to replenish via secondary market flows, then price pressure could be significant in a short time frame. Watch U.S. macro surprises and large ETF outflows as leading indicators of this risk. What this means for different viewers. Long-term investors looking for stores of value. If you are investing for long-term wealth preservation and you believe in an extended period of lower real yields or rising systemic economic risk, then allocating to physical silver or to well-established physically backed ETFs can make sense. The metal's industrial exposure adds a structural demand argument too. Keep position sizing modest and use dollar cost averaging because volatility can be large. Short-term traders and momentum players. Short-term traders can profit from momentum, but must manage risk tightly. Volatility is elevated, so use stop-loss rules and be prepared for abrupt reversals. Traders should monitor real-time macro releases, Fed messaging, and large ETF flows, which can quickly change the market microstructure. Industrial users and hedgers. If you run a business that uses silver for production, consider hedging strategies or forward purchase plans to smooth procurement costs. The current market is proving that relying on spot purchases alone can be risky during periods of constrained supply. Common questions from viewers answered. Is silver better than gold right now? Neither metal is categorically better. It depends on your goal. Silver can outperform when real rates fall and when industrial demand expands quickly. Gold tends to be a cleaner, pure macro hedge. Gold's market is deeper and more liquid, which typically means less volatility. Silver's dual role can mean higher returns, but also larger drawdowns. Are ETFs driving the rally? ETFs are a major component of demand because they require physical metal for each new share created. Large inflows into physical-backed silver funds reduce available metal and intensify upward pressure. There is clear reporting showing ETF inflows and record levels for major silver funds in 2025, which amplified the price move. Could new mining output cool prices quickly? Mining projects take time and capital to bring online. There are no immediate large-scale production expansions that can instantly offset strong demand. So while supply will respond over the medium term, it is unlikely to erase price pressure overnight, especially if industrial demand continues to grow. Practical steps for viewers who want action items. If you are an investor and you want exposure, decide your time horizon and risk tolerance. Consider a split approach for exposure. Use a portion in physical-backed vehicles or allocated silver coins, and another portion for shorter-term instruments. You must not over-allocate to any single commodity position. and always keep an emergency cash buffer. If you are a trader, set specific entry rules, stop losses, and profit targets. Consider smaller position sizes given the increased volatility. Monitor U.S. macro calendar, Fed speeches, and major ETF announcements as potential triggers for intraday moves. If you are an industrial buyer, lock in forward contracts or stagger purchases to avoid buying large volumes at peak spot prices. Consider talking to suppliers about scheduled deliveries and price collars to manage cost risk. How to stay updated. Follow central bank announcements, U.S. macro data releases, and major ETF flow reports. World industry surveys like the World Silver Survey are also helpful for longer-term context. The World Silver Survey and specialist reports highlight structural demand and supply trends, which matter beyond the immediate headline events. Final assessment and cautious takeaway. The current silver rally is the product of a macro pivot in U.S. monetary policy combined with persistent structural demand, especially from industrial users, and significant investment flows into physical-backed products. That mix makes this rally well-grounded, but also highly conditional. The path forward will depend on whether easy policy expectations stick and whether industrial demand, such as solar growth, keeps absorbing available metal. For U.S. investors, the prudent stance is to know your time horizon, manage position sizing, and watch the data that can flip the market quickly. Silver is trading at multi-year highs as of September 2025. The Fed's pivot toward easier policy created a strong immediate catalyst. ETF inflows and structural industrial demand, especially for solar panels, tightened available supply. The outcome going forward depends on Fed policy trajectory, U.S. inflation data, ETF flows, and industrial demand growth. Watch those levers and manage risk accordingly. Disclaimer: this video is educational only and not specific investment advice. Consult a licensed financial professional before making trades or investment decisions. The markets are volatile and losses are possible. If you found this helpful, subscribe for timely market updates and leave a comment with your question about silver. I will read and respond to the best of my ability. Thanks for watching, and trade and invest carefully.